So one thing to note about having a variable interest rate loan is that you can convert it effectively to a fixed interest rate loan at any given time by using futures contracts, specifically interest rate futures contracts. So let's say, for example, that we're looking at an interest rate futures contract and its price right now is 93.15. The way we get a yield from this interest rate futures contract, remember, an interest rate futures contract is just like a bond, and just like any bond, a bond has a yield as well as a price. The way we get it is by taking 100 minus this price that we see above. So for this futures contract, we get a yield of 6.85% by taking 100 minus 93.15. We get this number here. This is an annualized yield. 6.85% is an annual number. When it comes to futures contracts, we take 100 minus the price and we get a number that's already annualized. So we're going to use this futures contract as our futures hedge. This is going to be one side of the equation, so to speak, because on the other side, we're going to have our underlying bond. We are a company and we pay interest on our bonds that we've sold to our investors. And the bond that we sold is a variable rate bond. Every 6 months or every year, whatever our coupon payment schedule is, we have to pay to our investors whatever some benchmark rate is plus the credit risk premium. If it's a variable rate loan, we're going to have a floating rate payment. And the idea, though, is that if interest rates go up, then so does the cost of this floating rate payment. But with a hedge, what we want is something that when we take a position on this interest rate futures contract, as interest rates go up, then hopefully this futures contract, if we took the right direction on that position, goes up as well. So at the same time that our cost of interest on this variable rate loan goes up, so does the profit on our futures position on this interest rate futures contract. This is the idea of hedging. The two net each other out here so that effectively, no matter what interest rates do, these things move in tandem with each other and offset each other exactly. And that's why I keep using the word effectively. We still have a floating rate payment, but because we bought a futures contract that sort of reacts in exactly the same way as our interest rate payment, it pays off an amount equal to the increased cost of our payment, then effectively we don't have any exposure to variability in interest rates at all. Whatever interest rates are doing, it doesn't really affect effectively how much we have to pay to our investors. We take the profits from this in that scenario where interest rates go up and use those extra profits to pay the extra cost of our loan. That's the idea of using a futures hedge to hedge a floating rate interest rate payment. So just to illustrate this idea with numbers, let's pretend that this is the price and correspondingly the yield 3 months later. And today, actually, let's say that this is the price that we're seeing for futures contracts. For 3 months from now, an annualized yield of 6.85%. And the price today is 93.15. And instead, 3 months later, what we have is that interest rates have changed and they have gone down to 6.10%. So they've gone from 6.85% down to 6.1%. On this side of the equation here, the corporation, it's making a floating rate payment. And let's abstract from credit risk for the moment and say, whatever this company pays, they're going to pay the benchmark of whatever benchmark interest rates are doing. And in this case, what's happening is that benchmark interest rates are 6.1%. So this 3 months later, the company has to pay an interest rate on its loan of 6.1%. So in this case, interest rates have actually fallen, and it's cheaper for this company to make a payment on its loan. It's gone from 6.85% down now to 6.1%. But what the company wanted to do is just get itself a fixed rate payment. Regardless of whether interest rates went up or down, it wanted to hedge. When you hedge, you eliminate any payment uncertainty. And that means not only eliminating uncertainty of when interest rates go up, but when they go down as well. And the way they do that with the futures contract here, because on this payment, that if interest rates rise, it's going to be more expensive for them to make a payment, then what they want to do is take a short position on this futures contract. And if the interest rates rise, prices are going to fall for this futures contract. And a short position means you'll profit by that difference. So when you profit because interest rates are rising on this futures contract, because the treasuries prices are falling, you take that profit and then offset that from the higher cost of this floating rate payment. That's a hedge. But a hedge, like I said, it fixes your payment. And so that works both ways. In this case, interest rates fell, and our short position on this interest rate futures contract actually lost money. However, because interest rates fell from 6.85 down to 6.10, the cost of our loan also fell. And so the losses on this futures position we have are offset by the reduced cost of this underlying loan. And so whether interest rates are falling or whether interest rates are rising, the net effect with this short treasury futures position is it doesn't matter. Whether they go up or down, our effective cost of capital for this floating rate loan payment stays fixed. The two are perfectly offsetting each other. And in particular, what you see here is that the 6.85% going to 6.1%, this is a minus 0.75% annualized loss. But our loan has gotten that much cheaper as well. And so net on net, there's no difference for us in terms of what payment we make. And in fact, the math, just to clarify, it should be the other way. We started out, we started out at 6.85 and it went to 6.10. But what happens is that this is a futures contract and we shorted on this futures contract. So if we recall how we price futures profit and loss positions, if we sell a future or if we short, in other words, a futures contract, you take whatever a buyer of a futures contract would make and then multiply that all by -1. So whatever the buyer of a futures contract makes, The seller loses, whatever the seller makes, the buyer loses, vice versa. It's like a zero-sum contract. And that's why this is a negative number here. And another thing to note is there's another video that's in this chapter where we talk about treasury yields. And we got something called a simple yield by taking, the income we got from buying that treasury and dividing by the price paid. And that gave us a percentage yield. But the convention, I just want to make the distinction, the convention for pricing treasury yields is different than that for pricing interest rate futures. They're both interest rate sensitive instruments, but the way that we price interest rate futures contracts is that we take 100 minus the price, and that gives us our yield. I don't know why it is the way it is. It's just that I guess the exchange sort of prices things this way because then an investor looking at interest rate futures contracts can very quickly get an annualized number without doing too much work for whatever interest rates are for this particular contract. If this is, say, like a 3-month interest rate futures contract, they can see an annualized number by taking 100 minus the current trading price of the futures to get a annualized 3-month yield for treasury futures. So, for example, if we look at this 6.1%, you were given this yield, but you can back out the price of what this yield implies by this same approach. And so what you see is that 3 months later, given a 6.1% yield, that means this futures contract was now trading at 93.90. 100 minus 93.90 is 6.10. And so the price rose. And the price rose because of this inverse relationship between interest rate securities, their price, and what interest rates are doing in the market. And as interest rates fell, the price of this futures contract, just like a price of a bond, rose in value. And because we were short this interest rate futures contract, we actually lost money, even though that price rose. We were sort of positioning ourselves to profit if the price of this fell, if interest rates rose. And just kind of recapping, like, how do these two relate? Even if we get the idea behind what's going on with the futures contract, how it's priced when interest rates rise and fall, but how does that affect, or how does that hedge out our floating rate payment? And I think the way to really think about it is to kind of just visualize it as two different investment positions. It's just that one trade is offsetting the other. If you buy a stock, for example, stock A, and the stock rises in value. But when you bought stock A, you also bought stock B, maybe the same amount of money. in each stock. And when stock A rose in value, stock B fell in value. And if you put the same amount of money in each, $100 in stock A and $100 in stock B, and then let's say, stock A rose in value to 110, stock B, it fell in value down to 90, you can see the net result, nothing really changed at a portfolio level. And then likewise, if stock A instead fell to 90, but stock B went to 110, we still have, these should be 200. The same amount of money at an overall level, if you sort of holistically look at both of these two together in kind of like one portfolio. And that portfolio idea can be applied, is really how hedging works. So here we have a liability. We pay whatever the interest rates are doing in the market. Interest rates go up, they go down, so does our payment. But we use trading in futures contracts. If we buy the right amount of futures contracts, roughly, proportional to kind of the size of our floating rate loan payment, and we take the right side of the futures contracts, the idea here is that if the cost of our loan goes up by $100, we want to have a futures contract position that also goes up by $100 at that same time. Because the cost of our loan goes up by $100. We're paying that much. But fortunately, if we structured this right, our futures contract pays off by that amount as well. Likewise, if we actually save $100 because interest rates have fallen, so our loan payment is cheaper, well, we sort of agreed to go either way with futures contract. It's not like an option. It's like you either have the gain or the loss. In this case, we lost $100. But either way, the net effect, no matter what interest rates are doing, the net effect of these two contracts combined is zero. We still have our floating rate payment. It's just that effectively we've reduced or eliminated any exposure to us as a company to interest rate movements.